Hi, this is Albert, and welcome to part 2 of my series in the 3 biggest mistakes that buyers make. And today's session is on capitalization. Capital. Do I have enough money to run this business and sustain the business through the inevitable downturns of a business? I've laid out a quick scenario that I want to take you through and just illustrate how being undercapitalized is such a problem. So in this scenario, I have a business that's selling for $2 million, earning $200,000 on their revenue, so 10% to the bottom line. Let's say that business sells for $600,000, which is 3 times earnings, which is pretty typical, and more than likely this is a distribution business. So a buyer might go to the SBA and with 15% down, meaning $120,000 in a down payment, go ahead and be able to secure the financing to go pay for this business. So that leaves us with $480,000. The SBA is very good about always calculating a working capital allocation. So let's say they want to loan you the $480,000 and you have $50,000 in extra working capital. And then there are some associated fees. So let's just say that the total loan is $550,000. The debt service on that loan at 7% over 10 years is roughly $6,400 a month, or $78,600, let's call it $79,000 for the year. So those are the numbers that you're working with. And remember, this money here comes off of the earnings that you would have over here. So what is the problem? Here's a few examples. Where did we account for the landlord's security deposit? In today's environment, landlords want to make sure that their lease is secure. They may hit you up for 3 months, 4 months, and I've seen, especially in Manhattan, where security deposits can be as much as a year in a security deposit. Let's talk about the inventory for a second. So let's say this business needs about $400,000 in inventory to sustain the $2 million in sales. Let's say the business begins with $400,000 of inventory. How are you replenishing this inventory? Most inventory-based businesses, if you think about it, probably 80% of the sales comes from 20% of their offerings. So that means there's a turn. This inventory is turning. So as we're selling, we need to be replenishing. Where is the money to replenish the inventory coming from? You know, hopefully it's coming from the sales and the income on those sales. But remember, you just bought this business. This guy, the previous owner, might have wonderful terms with their vendors, 30 days, 45 days, 60 days in some cases. What are your terms? You have to investigate this. Maybe your terms are COD, and maybe you need to be out of pocket to purchase inventory. Do you have the capitalization to sustain the inventory purchases? How about any seasonality? When are you buying this business? If this is a seasonal business, are you buying at the right time? Do you have the reserves to be able to sustain the business that you're going into? These are some of the things that I go into in detail with my buyers, because undercapitalized businesses fail more quickly than just about any other kind of business. Because you get yourself in a cash flow crunch, then what? So if this is interesting to you, or you want me to help you with the situation, please reach out via LinkedIn, via email at albert@kensingtoncompany.com, or you can call me at 516-626-2211. And this is my lead-in to next week's session, which is on the right team. Thank you.